Hey everybody, it is Eric Green. Um, what I wanted to do with this week's podcast is talk about a topic that everybody who does offers and compromise should be aware of, and that's called dissipated assets. All right. So first and foremost, what is a dissipated asset? Now, by the way, I call this dissipated assets death of an offer and compromise because usually if you have a dissipated asset issue, that generally will be the end of your offer and compromise. I'll explain that in a moment, but let's talk about what a dissipated asset is. A dissipated asset is an asset that where the value should have gone to the IRS to pay the tax debt, but instead went somewhere else. And that somewhere else was not an allowable expense. So I'll give you an example of this. Client comes to me, all right, and they have stock, like $20,000 worth of stock. They sell the stock, right? They collect about, $15,000, $16,000. They sell the stock, they pay their tax, $15,000 or $16,000 net left over. And what they do with it, instead of using it to pay the government, they go and they pay off mom and dad who had loaned them some money that did not have a lien filed. Well, if the IRS comes in, they say, well, wait a minute. That 15 or 16,000, we have a tax lien. That should have gone to pay us. So, Mr. and Ms. Taxpayer, we're going to add that back to your offer. So that offer you made us just went up by the $15,000 or $16,000 because it has to be included because we should have gotten it. Right? So what happens is this: the taxpayer owes the government money. They have assets. If the assets are used to pay other unsecured, not allowable expenses, right? And I've had this where we pay back mom and dad instead of the government. We go and take a Disney cruise. I had a client do that, cashed in a bunch of stuff, took everyone on a Disney cruise, and then went and filed an offer and compromise. Well, the government saw it. They saw that the stock sale got reported. They saw the money go into the bank account, and they saw the money go out to Disney Cruise Lines. That's dissipated, has to be added back, right? Now, you may have also heard me talk about how we can use assets to our advantage. So for instance, the client comes in, we're going to do an offer and compromise. Let's say they have no equity in their house, no equity in their cars, their future income, let's just say it's $1,000 a month. So that would be $12,000, right? 12 months of future income, so $12,000. And they have an IRA. And the IRA's got $10,000 in it. Well, the IRS would say, well, 70%, right? You got to pay the 10% early withdrawal penalty, the 20% for taxes. That leaves $7,000. Add that to the offer, so now we're at 19. Well, let's say my client, what if we could use that $7,000 from the IRA to our benefit? Now, what do I mean by that? Well, what if we owed for medical expenses? Well, that's an allowable expense. What if we hadn't made enough in estimated tax payments? I can use the $7,000 for that. That's an allowable expense. You are allowed to use assets for current allowable living expenses. So for instance, my house is going into foreclosure. So I liquidated my IRA and I used it to get my house out of foreclosure. Housing is an allowable expense. That's not a dissipated asset. So if you have a client that has used assets, the next step is, well, what did we do with it? Now, people will tell you, oh, they used it to pay credit cards. That's unsecured debt. That's not allowed. Well, wait a minute. What's on the credit card? Now, I have to tell you, the IRS is going to go through a real analysis of this. So you need to. I mean, this does become, I have to admit, kind of a pain in the ass. But you use it to pay your credit cards. Why? Well, we're living on them. Well, show me. And if everything on the credit cards is medical or food or housing, and when I say food, I don't mean restaurants. I mean going to the grocery store. If what's on the credit cards is allowable, then it's not dissipated. You're allowed to use it. Now, the thing you usually find is some of what's on the credit card is allowable, and some of what's on the card is not allowable. So a percentage will be allowed, and a percentage will be considered dissipated. So to wrap this up summary-wise, what is a dissipated asset? A dissipated asset is an asset that where in an offer and compromise, the government should have gotten the money. It would have been, in other words, it should have been included in the offer. And because it's not, the IRS is going to insist that it be included. So the first thing you have to do is, do we have, and by the way, the look back for a dissipated asset, after they did the 2012 Fresh Start Initiative, they reduced it to 3 years. So you only have, so by the way, when I ask clients to come in, and you've heard this before on the podcast, if not, go back and listen to the earlier episodes and you'll hear me talk about when the client comes in, I want the last 3 years of returns. Why do I want that? Well, a couple reasons. One, I need to look at the income. If the person's income is going up and down, the IRS is going to try to come up with some sort of an average. So I want to see what's been going on for the last 3 years. Well, what I'm also looking for is dissipated assets. How would I know if there's a dissipated asset? Schedule D, Form 4797. Are there any gift tax returns that have been filed for the last 3 years? I asked the taxpayer that. The reason is, if they sold off assets, Schedule D or 4797, what did you do with the money? Okay, that's going to be critical. Now, if the money was used for allowable expenses, we're fine. If we're not, if it weren't, it's going to have to get added back to the offer. So go through that analysis and talk to the client about it. Now, you may add it back and the client may still be able to do the offer. So great, but, and by the way, I don't include the dissipated asset when I submit the offer. It's not my job to do the government's job for them, right? So what I'm going to do is I'm just going to submit the offer, all right? And let's say, again, we have our $1,000 a month of future income. We have this $7,000 dissipated IRA. The net of the IRA is $7,000. I'm going in with an offer of 12. It's not my job to do the IRS's job for it. Now, by the way, we never provide false information, right? We've talked about evasion of collection cases before. So we're not going to evade or lie or mislead, but it's not for me to go and point this out to them. So we're going to go in with the $12,000 offer. However, the client is aware they do have this potential dissipated asset issue. So it will not be a surprise if the government comes back and say, hey, wait a minute, we know you cashed in the IRA, what'd you do with the money, right? And if it didn't go to an allowable expense, that would have to be added back to the offer. And the client may say, look, Eric, if the offer goes to 19, I can still borrow the money. I still want to do it. But we're going to go in with the 12. If it goes to 19, it goes to 19, right? Sometimes the government doesn't catch it. And that's not our problem. That's their problem. And we go forward with the offer of 12, right? But so it's fine. You don't have to do the government's job for it. But what you don't want to do is intentionally mislead or provide false information to the IRS, right? Because now you're crossing the line into 7201 evasion, 7206, the making of a false statement or filing a false document with the IRS, or quite frankly, potentially both. But if you do the other, so one, that's what a dissipated asset is. That is the impact it has on an offer. It is for the last 3 years, okay? First of all, if you do have that situation, make sure it's actually dissipated. It may not be. I had to pay my credit card. Well, okay, what was on the credit card? I had to charge all these medical expenses. Prove it to me. They go and they get the credit card. You see all the medical, you see the money come in and they pay the credit card down. That's not dissipated. Medical expenses are an allowable expense. The fact that you did it with a credit card, that's a form of payment. So the fact that it hit a credit card is not the end of the analysis, number one, okay? Number two, if you do have a dissipated asset issue, all right? The client liquidated $50,000 and paid back his brother, who, by the way, did not have a lien filed, was behind the IRS. That $50,000 is going to get added back to the offer, and there's no way he can do the offer. what I would tell the client is, look, we got to wait 3 years. We can make you uncollectible. You can get into a payment plan. You just can't do an offer right now because they're going to include it. We have to get out until you have 3 tax returns that are filed beyond the dissipated asset. So if, let's say this happened in 16, we have to wait until we have 17, 18, and 19 on file before we can go forward with an offer, because it's a 3-year look back, right? We have to get out past 3 years based on tax returns filed. We have to get out past 3 years in order to do the offer and not have that dissipated asset come back in. All right. So hopefully, if you're doing offers in compromise, you've just learned a little bit more about dissipated assets. That is the way they work. If you have any questions, go ahead and email me. It's in the link below. And remember, the next AMA episode that we're going to be doing, which is AMA, remember, is Ask Me Anything. Even though it says ask me anything, and you can ask me anything, but we're going to focus on liens. I got a lot of really great questions that we did not get to last month on the AMA, and since then on liens, discharging liens, and some levy questions too. So I think we're going to be doing the AMA toward the end of July. We'll be doing the AMA episode on liens and levies. So if you have any question, please go ahead and email podcast@taxrepllc.com. It's also going to be in the link below. And thank you all for tuning in this week. And I'll talk to you next week. Bye-bye.